The Federal Reserve today said that default rates on a whole range of household loans have risen sharply. That's a reflection of the deterioration in the labor market. The New York Fed also reported that rejection rates have soared this year to new series high, and the credit cycle is just getting started. And that has put a spotlight on an arcane bit of Wall Street bank balance sheet engineering, a new spin on the old credit default swaps that has seen an explosion of popularity this year, because of course it has. One reason why is what I just said. Credit quality is deteriorating, so banks are in the market for credit protection. And that market is booming right now, as those investing in said protection are much the same institutional non-bank investors who have been caught flat-footed on macro risks back in early August. They've got soft landing fever. So while everyone is reaching for yield, and that means accepting lower and lower payments for guaranteeing losses, at the same time, the risks of doing so are rising. Just ask the banks who are demanding it. It becomes a feedback loop where further setbacks in employment and incomes lead to worsening credit quality, which only raises the demand from banks for more credit protection these private non-banks right now are happy to supply. And once it goes too far, they stop supplying or they demand too much of a rate to keep it up. At that point, banks, they're already cutting back on credit, rejecting loans at an unusually high rate, and then they have to reject a whole lot more. The credit cycle gets a whole lot uglier as a result. And there are also a number of other questions related to these credit protection schemes, including who actually is funding them. But we'll save those for a later time. Today, we're just going to focus on the credit cycle and the impact of this Wall Street engineering, potential impact of this Wall Street engineering as the credit cycle continues to deteriorate. But first, to the Federal Reserve and its household debt and credit report for the third quarter of 2024. And the headline part of it was the total delinquent balance on all household debt shot up to 3.5% in the third quarter of this year. That's up from 3.2% in the first and second quarters. And what you really see, though, is that the credit cycle began to shift in 2023. Delinquency rate was around 2.5% in the fourth quarter of 2022. It ticked up a little bit in the first half of 2023 to 2.6%, but the second half of last year, as unemployment began to rise, that's when we see delinquency start to move up as well. Now, 3.5% in the third quarter of 2024, it's not a huge amount. It's not devastating. It's not a massive four-alarm fire. In fact, it compares to around 4.9% in the first quarter of 2007, which shot up to 5.7% by the end of that year. And right now, the direction is heading in the wrong way, the wrong direction, and doing so in a way that suggests that we're still in the early stages of this credit cycle change. 90-day delinquencies on credit cards shot up to 11.13%, which is the highest since the first quarter of 2012. And even for auto loans, which is a big one, 90-day delinquency shot up to 4.59% in the third quarter of this year, which is similar to late 2010s or 2010 itself, which means the later stages of the credit crisis, at least as far as auto loans are concerned, which is a big one, and we'll come back to that in just a moment. Now, there was a little bit of good news in the Federal Reserve report, and that was that new delinquencies or transitions into delinquencies were actually down for credit cards in the third quarter compared to the second quarter. For credit cards, the transition rate went from 9.05% down to 8.79%, while for auto loans, it ticked up higher. And we see the improvement in credit card transitions is likely because banks have cut back on the access to revolving credit, as we pointed out as another cyclical indicator in previous videos. So revolving credit, banks are rejecting that and refusing to extend new lines, but auto loans is where a lot of the trouble is starting to really pop out. And the FRBNY statement said, reported rejection rates for credit cards, mortgages, auto loans, credit card limit extension applications I just mentioned, and even mortgage loan refinance applications all rose in 2024, which makes perfect sense. When confronting a possible shift in the macroeconomy, therefore anticipating a change in the ability of consumers and borrowers to be able to pay back all their loans, households to be able to pay everything back, As a bank, as a financial fiduciary, of course, you're going to start taking a second, harder look at prospective borrowers, and you're going to start rejecting more and more loan applications, not wanting to take on the risks that are actually rising. So according to the Fed's data, the average rejection rate so far in 2024 is 21%. That compared to 20.1% in 2023, and it had been as low as 17.6% in the pre-pandemic era. For just mortgages, the rejection rate soared to 20.7%, which is up 8.6 points, and it was double the rate from 2019. Even mortgage refi rejections moved up to more than a quarter, 25.6%, which is the highest in the series. It had been only 15.5% in 2023. And auto rejection rates went up to 11.4%, which is the highest in 2013 and the start of the series there. Again, that's a reflection of the deterioration in the labor market. Lenders are looking at their prospective borrowers and demanding more and more documentation and seeing the income documentation that it gets worse and worse and worse, income prospects that are diminishing. They're increasingly rejecting loans no matter what it is that households wish to borrow for. Now, auto loans in particular have come up quite a lot this year, including, as I mentioned in a couple of the previous videos, Ally Financial. It was Ally Financial's CFO back in September at the Barclays conference who raised a lot of eyebrows for what he said. And over the couple of months since that conference, it hasn't gotten any better. He's actually clarified his comments even more as Ally Financial itself has reported more and more information about it. The latest from earlier in November, Ally Chief Financial Officer Russ Hutchinson said that in post-pandemic times, 2022 in particular, consumers flocked to buy cars when used auto prices were elevated, saddling themselves with bills at a time when they had yet to realize the full impact of soaring prices. While those borrowers still have jobs, he said, they're grappling with stiff loan payments on top of car ownership costs that are also up. What he's really saying is what I keep pointing out, the price illusion. It's not necessarily about the prices, it's about incomes that have not kept up with them. So when everybody was buying used autos back in 2021 and 2022 at absolutely obscene prices, they did so thinking that their incomes would eventually catch up to where prices were, and that would justify the high cost of doing the purchase. Even higher income consumers are struggling with how expensive cars, both new and used, have gotten over the years. Well, it's not a widespread practice across the industry, not yet, according to the Fed. Ally has been verifying the income and employment for potential borrowers in more cases, rejection rates going up, especially when they're taking on potentially steep payments, according to what Hutchinson said recently. And again, this makes perfect sense. The economy starts to show more and more weakness, deterioration in jobs and income. Banks respond to it prudently by raising their lending standards. They've been talking about raising lending standards since 2023, and now we're we're seeing all of the major impacts from that. It's now having its greatest impact on the economy, which is why, as I've shown several times in videos, there's such a high degree of correlation between lending standards and cyclical lending indications, and therefore the unemployment rate, usually with a year or so lag. And here we are about a year or so after the lending standards began to be tightened, and we're seeing all of those impacts. While all that makes perfect sense, is quite understandable, banks would be rejecting more and more loans, tightening lending standards. That's not the only thing that they're doing. They're taking proactive measures to ensure their balance sheets as credit quality deteriorates further and further. Let's go back to Ally Financial. This time a couple months before the Barclays conference. Ally executed its first credit risk transfer, or CRT, during the 3-month period. That was the second quarter of the year. One way the firm can build capital ahead of looming Basel III rules that would force banks to do so. CRTs are another tool in our toolkit to generate capital and better serve our dealer customers, Rhodes said in a conference call with analysts. Chief Financial Officer Russ Hutchinson said Ally can be expected to do more CRTs in the future. And so what are CRTs? Credit risk transfers, or sometimes called SRTs, which are significant risk transfers. CRTs or SRTs are essentially sort of like credit default swaps. They're not credit default swaps specifically, but they are very much like them, and their purpose is quite similar to how credit default swaps were used. Contrary to popular perception, Default swaps were not really about managing risks or getting insurance on specific assets. It was used by the banking system for what was called regulatory capital relief, basically manipulating bank balance sheets to make them more efficient. If you could take a risky asset or a risky pool of assets and get some form of guarantee to lower the perceived as well as calculated risk of holding those assets, you can then argue that those assets are less risky, which means you have to hold less capital against it. And if you have to hold less capital against the pool of assets that you've just guaranteed, that means that you can do more for the same amount of capital. Your balance sheet becomes much more efficient. So SRTs or CRTs, but I think they're most commonly referred to as SRTs, they're like credit default swaps in that respect. You pay some investor to take the hit on potential pool of loans or some other assets. And so they're used in the same way for regulatory capital arbitrage on risky loans, but with those guarantees, they're treated as lower risk. Therefore, you get to lower the risk weighting, which means you can hold less capital against them, use your balance sheet more efficiently. But they do come with a cost because you have to pay an investor a premium to guarantee a certain amount of losses under a certain set of circumstances. That all depends upon the type of SRT that we're talking about. And there are a few different types of SRTs. Most of them, as I understand them, are funded, which means they're 100% collateralized, where the investor has to post some form of collateral, whether it be cash or something else, with a third-party custodian. And there are unfunded SRTs too, which are usually the counterparty on the other side of that is some highly rated insurance company. Though the bank doesn't necessarily like unfunded SRTs because it subjects the bank to a haircut since there is a non-zero risk and they're not fully collateralized. But the most popular this year, the most popular form of SRT is something called a credit-linked note. This is not anything new. It's something that Wall Street has been employing for decades. But it has seen a resurgence in popularity for, which should be obvious reasons, with the credit cycle beginning to more and more turn. But there are also regulatory reasons why we've seen an explosion of SRTs and credit-linked notes this year in particular. They were popular over in Europe after the last financial crisis because the banks were really struggling and the credit default swap market was basically dead from 2009 forward. So you see a lot of issuance of credit-linked notes. And a credit-linked note is just where the bank or a third-party special purpose vehicle will issue a note to investors for cash. The investors post cash as collateral, and the principal value of that note gets reduced for any losses that are experienced in a loan pool. So it's sort of like an insurance policy on credit losses or other types of adverse events on the pool of assets that the bank owns. Now, the regulatory treatment in the United States of these SRTs was uncertain, to say the least, up until last year. Now, there's a whole bunch of issues going on here that we don't have time to get into here on YouTube. That's something that I'm going to be writing about extensively in today's deep dive analysis, by the way. So if you want more information about what SRTs and CRTs and repo and liquidity implications and all of the more complex relationships, what all that entails, you've got to go to Eurodollar University's deep dive analysis for that. Like I said in the intro, here we're going to focus on the potential credit cycle implications of SRTs. And like I said, last year, as part of the Basel III endgame, which is another topic that I've written extensively about in the deep dive analysis, essentially the Federal Reserve clarified its stance on these types of credit derivatives that banks use for regulatory capital relief. And last year, the Federal Reserve published an FAQ about a whole bunch of things that included CRTs. So they are not only aware of SRTs and CRTs and credit-linked notes, you have to go to the Fed essentially for approval. As Jay Powell said earlier this year in testimony before Congress, banks do tend to bring SRTs to us and we look at them carefully. But at the end of the day, if it works to reduce the risk on the bank's balance sheet, that's something that we should be okay with. But what we have seen this year is that the appetite to do SRTs has gone way up for the reasons I've been stating. At the same time, the demand from the investors who are supposed to be outside the banking system has also gone way up to provide protection, because if you believe the U.S. economy is heading toward a soft landing, it's strong and resilient, as Jay Powell says, then you're more than willing to provide credit protection that you don't anticipate experiencing many losses on, if any losses, for a fee. So you get paid to provide protection that you never expect to pay out. It's like being an insurance company for some type of loss that will never actually happen. You just pocket premiums, and sometimes those premiums can be pretty substantial. So these private and institutional investors are pretty sanguine about the risk prospects, so they're all piling into this to reach for additional yield. And banks are only too willing to satiate that desire because they're looking for credit protection and seeing better prices for it. It's almost as if like you're in Florida and you see a hurricane barreling toward the coast and you look for a little additional protection on your house, and suddenly all of the insurance companies that provide homeowners insurance are lowering their rates. It's not a perfect analogy by any means because there's differences in opinions about what's really coming in front of us, but it's the same type of thing. You're a bank that you see a storm coming in the credit cycle. You want a little bit of extra protection, like Ally Financial said, and the market's only too happy to provide that protection at lower and lower rates. Banks are going to be doing more and more of it. But what happens when this market dries up? Now, there's also collateral issues that I talked about. We won't get into here. But when this market dries up, whether it be the funding for the collateral in the credit-linked notes or the SRTs and some of the other more esoteric formats, what happens if that market dries up? For all these private institutional investors that are gobbling these SRTs up and pocketing the spread on them, what happens when they realize that maybe the risks that they perceive were very low suddenly are not very low? Well, what happens is we see something like early August of this year, which was not necessarily related to SRTs, but the same types of assumptions that drove the carry trade, that the U.S. was in a really good place and that risks were low. Suddenly, the system says risks are not very low. Banks no longer are able to access and purchase SRTs at the rate that they are willing to pay and are able to afford. What happens then is the credit cycle that's already deteriorating has to deteriorate a lot more. Because if banks can't buy credit protection as the cycle continues to go in the wrong direction, they're going to start rejecting even more loans because they have no way to offload some of the risk that they're taking on. So they won't take on the risk. It's a pro-cyclical factor that exacerbates the credit cycle, potentially. So it's another factor to consider on top of the deterioration that we're already witnessing and the evidence that we're getting in that respect from the Federal Reserve Bank of New York and from other sources, including the banks themselves. So setting aside any more of the complicated questions about the funding of SRTs and everything else and collateral implications as well, we have a further pro-cyclical headwind for the economy and the credit cycle because banks, as much as they're rejecting applications and tightening lending standards now, how much more will they have to do if they realize we have no ability to offload credit risk onto the other parts of the economy? That's really what's supposed to happen here. The point of an SRT is not from an individual perspective, it makes perfect sense. But from the systemic perspective, it means that the system is able to spread out risks more broadly, which is a good thing. I mean, I have to agree with Mr. Powell here in that if a bank can offload some of the credit risk to other parts of the system, you want risk to be spread out and not concentrated. So SRTs, in theory, are a very good thing. The problem that we have is that the credit cycle has shifted and that deterioration is becoming more and more evident. What we don't know is what happens when the SRT market starts to go in the wrong direction. How will banks respond to that? And I don't mean bank failures. That's not what we're talking about. We're talking about potentially a pro-cyclical headwind for both credit as well as the overall economy over and above what we're already witnessing. So delinquencies are already up because of labor, jobs, and incomes. That's why there's a correlation with unemployment, the household survey, and those types of metrics. So you get more headwinds on an economy that's facing quite a few already that people are kind of just glossing over because of Jay Powell or more recently because they're more sanguine about prospects given the election of President Trump. But there is more than a fair amount of uncertainty about just how SRTs might ultimately play out. Not necessarily, as I said, a bank crisis, but spread out risk making the banking system more flexible. That's what they do when they work. They can end up making the system more rigid because banks have come to rely on them during these less than ideal circumstances, which means as the credit cycle continues to change, the pro-cyclical nature of it, the rug pull, can become a lot worse. We've gotten other cyclical warnings too in the form of the US dollar exchange values. There's the euro and the yen and the rupee and the yuan. Did a couple videos on each of those. The one I've got linked below is the euro and the yen. As always, thank you very much for joining me. Huge thank you, Eurodollar University members and subscribers. And until next time, take care.